let's talk about your debt. In order for lenders to be able to get that loan backed by the government, they have to follow the guidelines for something called debt to income ratio. So what that means is when we look at how much you make every month compared to how much debt you have, it has to be below a specific number. So that specific number is going to depend slightly depending on what type of loan that you have. But let's just say, just in general, when you're looking at all the different debt that you have, it has to be less than 50% of your income. When we're thinking about debt, we're not talking about the total number of loans you have. The lenders are looking at your monthly payments. So if you have a payment for a Chase credit card, that's $30 a month, and then a payment for your student loan, that's $150 a month, and then a payment for your car loan, that's $500 a month. They're going to add up that car loan payment plus your student loan payment plus your Chase card payment, and they are going to look at, compared to your income, what percentage of your income is going towards that debt, right? Now, when they take that debt you already have plus your potential mortgage payment and put those together, it cannot be more than 50%, sometimes 40%, depending on what type of loan you're getting specifically, right? So now the thing that a lot of people disregard is that when you're racking up all these different debts, so if you have 10 different credit cards, they all have balances on them and they all have monthly payments. You have a car loan that's $1,000 a month, which I think is crazy. And then you also have all your student loans. Maybe you have 4 different loans and your total payment from that is $700 a month. When you add up all of those different payments, that alone could take you out of the game. So even if you make a whole lot of money, if you have a whole bunch of different debts that have all these different monthly payments, that could potentially get you out of the game from being able to get a mortgage loan simply because of all the debts that you have, right? So you could be making a lot of money, but then if you have a whole bunch of payments, that's it, you can't qualify. Similarly, if you don't make a lot of money, but you don't have a whole bunch of monthly payments, then you could potentially qualify for a mortgage, and maybe an even bigger mortgage than someone that actually makes more than you. Simply because like they have a whole bunch of different debts, and those debts are going to impact how much they qualify for. And not just that, just to make sure it's crystal clear, not doesn't just impact how much you qualify for, it can even just, if you're over that, that threshold, that percentage where it needs to be, you can completely just not even qualify. And that's it.